Now, it's time to review the next rule of the weekly envelope trading strategy. Let's consider money management rules. As I mentioned above, in accordance with the rules of the weekly envelope trading strategy, the size of a trading lot at the time of opening and adding a position depends on the price level at which these operations are performed. Let me remind you that traders should try to ensure that the maximum volume of opened positions is concentrated at the price level located close to the central line of the envelope. This is true for both standard and corrective scenarios. In case of the consolidation scenario, where, as you remember, the signal for opening a position occurs immediately after a confirmed breakout of the support or resistance level on the weekly chart, the rules for opening and adding of a position are slightly different. However, in any case, the overall risk in one single transaction must be limited by a fraction of the deposit not exceeding 5%. In addition, the maximum number of open positions in a trader's portfolio should be no more than 3. Suppose a trader opens a live trading account and funds it with $5,000. Thus, in a single trade, trader will risk no more than $250. As you know, in accordance with the rules of the weekly envelope strategy, the size of the stop loss can vary from 1 to 3 ADV. Thus, knowing the amount of risk in pips and dollars, trader will be able to determine the size of the trading lot in base currency units or contracts. Also, in view of the fact that in certain circumstances, the size of open position can be both bigger and smaller, trader uses a special risk factor for adjusting the size of the transaction. Depending on the market situation, risk factor may be equal to 2/3, 1/3 or 1. Let's look at the first example. Suppose a trader received a signal for opening a short position in accordance with the rules of the standard scenario. In this particular situation, trader should take into account that the size of the risk in points is big enough, and market may start an upward correction at any moment. Therefore, the amount of financial risk and, consequently, the transaction volume should be no more than 1/3 of the estimated. Trader opened a short position and placed his stop-loss order at the upper band of the envelope. Later, market price continued its decline. However, target number 1 had not been reached, and the market indeed had entered into a phase of upward correction. After the price had reached the central line of the envelope during the process of correction, it formed a reversal, and generated a second sell signal. Accordingly, immediately after receiving a new sell signal, trader increased the size of the open short position through additional sale of 1/3 of estimated volume of transaction. Thus, the total amount of the financial risk in the transaction amounted to 2/3 of the estimated volume. After increasing the size of the short position, the stop-loss level and the target number 1 level have been adjusted. Later on, as price continued to move in a favorable direction, the stop-loss order was first moved to the break-even point, and then turned into a trailing stop, located at a distance of 200% of ADV from the new local minimum, reached by the market. In the end, after 3 months the short position was closed with profit. Now, let's consider another example. Suppose a trader received a signal for opening a long position in accordance with the rules of the standard scenario. In this particular situation, trader should take into account that the size of the risk in points is big enough and the market may start an upward correction at any moment. Therefore, the amount of financial risk and, consequently, the volume of transaction should be no more than 1/3 of the estimated. Trader opened a long position and placed his stop-loss order on the lower band of the envelope. Later on, market price continued its rise, and target number 1 was reached. Trader moved his stop-loss order to break-even point. After that, market entered into a phase of downward correction, in which the long position was closed at parity. After reaching the central line of the envelope during the correction, price formed a reversal and generated a second buy signal. Accordingly, immediately after receiving a new signal, trader reopened a long position with a volume equal to 2/3 of total estimated. After opening a position, a stop-loss order was placed on the lower band of the envelope. Later on, as price continued to move in a favorable direction, the stop-loss order was first moved to the break-even point, and then turned into a trailing stop, located at a distance of 200% of ADV from the new local maximum, reached by the market. In the end, after a month and a half, the long position was closed with profit. In the following two slides, are shown the layouts, under which the operations of opening and adding a position must be carried out. It should be noted, that in the first case, the total amount of financial risk and, consequently, the volume of the transaction, amount to 100% of the estimated, since the addition of the position is made at a price level, which is located within the area of plus/minus 1/2 of ADV from the central line of the envelope. In the second case, the total amount of financial risk and, consequently, the volume of the transaction, amount to 2/3 of the estimated, since the addition of the position is made at a price level, which is located outside the area of plus/minus 1/2 of ADV from the central line of the envelope. So, working with a medium volatile instruments of futures, equities and Forex markets, in the framework of position size management applied to weekly envelope trading strategy, the leverage of a trader will not exceed 5-to-1, for each of the 3 positions held in his portfolio. Now, let's talk a little bit about the performance parameters of the weekly envelope trading strategy. As you already know, within the proprietary method of trading a portfolio consisting of several trading strategies, long-term trading strategy weekly envelope, along with a medium-term multi-time frame trading strategy, are primarily used to determine the direction and the likelihood of a positive outcome of the transactions made by the rules of the full version short-term trading strategy double barrel gun. Despite this fact, the weekly envelope trading strategy, as well as other strategies included in the portfolio, is self-sufficient and can be used for standalone operations in the framework of the long-term perspective. In confirmation of this fact, I would like to give you some specific figures. Statistics on the main indicators of the effectiveness of the weekly envelope trading strategy looks quite decent. I will say a few words about this later, but first, let's return to the question of the likelihood of the trading strategy's failure. In order to secure a comfortable working environment, any trader should understand what profit-loss ratio, and what percentage of winning trades in the series, will be able to provide him with high reliability performance, and a low probability of failure, of the weekly envelope strategy. As I mentioned earlier, in the series of videos about the double barrel gun trading strategy, for the short-term strategy, the percentage of profitable trades in the series is more essential, in contrast to the long-term strategy, where a more important role is played by the profit-loss ratio. Based on the matrix of trading strategies failure, it is possible to conclude the following. In order to ensure the stability and sustainability of the trading results of the weekly envelope strategy, the profit-loss ratio parameter must be in the range from 2-to-1 to 3-to-1, or higher. In this case, even if the share of the winning transactions in the series will be only 40%, the probability of strategy failure would not exceed 9%. Now, let me bring to your attention the statistics collected in the process of backtesting of the weekly envelope strategy on historical data. Here is the equity curve of the strategy, when using the method of money management described above. Here are the statistics covering the 5 years time period, from January 2011 to December 2015. This series covers the transactions for the most liquid and most popular among traders' currency pair, Euro versus US dollar. For the testing purposes, the initial amount of capital was set at $5,000. During this period, 43 transactions were performed in accordance with the rules of the weekly envelope strategy. As you can see, positive returns were received after the period of backtesting. If we talk about the specific numbers, then the main indicators of the effectiveness of the weekly envelope trading strategy look as follows. Profitability of transactions is 289%. Maximum drawdown of the account is 13.47%. The share of winning trades in the series is 91%.